Jim Penna, who is the manager of the retirement services. And I look, and Jim has been here for 12 years. So thank you for being here, Jim.
Yes, Glenn, we have, what we've just done when you pull that graph up is shift gears tremendously here at what we're looking at. As you mentioned earlier, as manager of retirement services, my outlook on a lot of these stocks has changed. I'm looking at a longer term, safer, more prudent stocks, overall, not that those aren't good quality stocks that we've seen already. But I'm looking at stocks, you'll see I'm starting on a 1-year graph for a stock like HEI Corp. We talk about hot stocks, and what I'm kind of characterizing mine at this point are more like a slow burn, right? I'm looking at a little bit longer term, so understand that as I go through these. We're looking at just a graph of a stock. This is a 1-year graph of HEICO Corp. It has been a wonderful stock. We own it in our retirement portfolio. You can see these guys have already addressed earnings in that earnings graph on the subgraph, that lower left to upright pattern. I think I got this from Steve probably 10 years ago. There's no coincidence that the price of the stock continues to rise, as does the earnings. So that's the concept that I look at when I'm looking at the retirement-minded stocks when we talk about hot stocks. Now this actually could and should qualify as a hot stock even in the shorter term, but that's not what I'm looking at it as. If you go ahead and you could even put a 5-year on here, Glenn, if you wanted to, and we can see even the 5-year look, how earnings continue to grow and how that stock continues to move. I learned also a long time ago on the trading desk, 100 years ago when I worked on the trading desks, from one of the best traders I'd ever met. When you're looking at graphs and you're looking at a time frame that you're trading that in particular stock, that's the graph you want to look at. That's the time frame you're looking at. Now, what I'm doing is looking at a longer term, not so much a buy and hold, because there's still an investment strategy behind these stocks, but I'm looking at certainly a longer term. So I'm more apt to look at a 1-year graph, a 3 or 5-year graph when I'm looking for stocks like this. So for me, again, the slow burn stock for a quality stock in your retirement portfolio or your more conservative portfolio is a stock like HEI. And then Glenn, I know I'd asked you earlier, if you go to the viewers tab real quick, go to stock viewer. We had typed these in earlier. All you have to do is type them in to the search box up top. Oh, I guess we got to type them back. HEI, and you could put up NEE while we're up there. So he talked about doing homework on a stock, and you certainly should get all the information you can. But here you have just an abundance of information just from our stock viewer page. So again, HEI is at the top there, priced at 140. It's also overvalued, but Steve already made the point. It's a snapshot in time. As earnings rise, that value will continue to rise. At some point, we say they're likely to meet. If earnings continue to grow, we see a 20% earnings growth rate there, they'll continue to rise. What I focus on when I look at a stock like this, my homework consists of looking at relative safety, the consistency and predictability of a stock's financial performance. And I always say, what two better adjectives to define the type of stock that's in your retirement portfolio than consistent and predictable? So this is what we look at for the growth stock side of that. A great relative timing because it's doing well now, a comfort index of 1.58, and a nice earnings growth rate. It also pays a small dividend, but that's not our main purpose for buying it. So that's what we look at, a stock like HEICO. To me, that's a hot stock for a retirement-minded, a little bit longer-term portfolio.
Keep going to the right there, Glenn, on the dividend analysis. Look at that safety number, 99.
Yeah, the 99 comes in. It's a great. The dividend safety is a proprietary number in VectorVest.
Excellent, that's right.
It's the one indicator that's not on a 0 to 2 scale, so it's 0 to 99. Anytime you find a dividend-paying stock that has an RS above 1.4, that dividend safety is going to be at 99, right? Why? Because earnings are consistent and predictable. The dividend safety is directly related to the company's ability to make money. Now, I'm going to contradict myself just to segue into next era here, NEE. With a dividend-paying stock. So before you guys comment, I'll switch over to next year since we have it up here. Now, I changed gears here again because this is part of a dividend growth portfolio. So if I'm looking for a hot stock, again, depending on my objective, next era is one of the great ones here. You've got a dividend, $5. The yield is a little lower now because the stock has been going up, but I can't see the yield.
2.3.
2.3, and that was even higher, but the stock keeps moving up. So of course, they work in an inverse relationship, so the yield is going down. But you've got a $5 dividend on the
These
stock.
days,
Yeah, I mean
it's
that's
not bad.
that's pretty good. So you're looking at a strong dividend safety. Now the number, if it hasn't already, that should be standing out to you is the growth rate. We have a little different outlook on our dividend growth stocks when we're looking for them. You'll see also the RS. Actually, that's a stronger RS than most of the dividend growth stocks we look for. And the reason is these are more mature companies. They have a free cash flow. The earnings aren't negative. They're still making money, positive. Their growth rate has slowed. But I'll comment more if you want to go ahead to the graph now on next year.
So the yield is outpacing, the earnings yield is outpacing the dividend yield.
yes.
Yes,
So
and a
in
great,
the long term, at a slower growth
Yeah,
or negative
great.
growth rate, it could come in jeopardy.
yeah, great
Long
point.
term.
When we calculate that payout ratio, the quickest way to do it is dividend safety. Anytime you have a dividend safety above 50, it's going to tell you that that payout ratio is favorable, and the ratio is what Todd just mentioned, where the earnings yield or the earnings per share, whichever one you want to use, is greater than the dividend they're paying out. If it's not, you've got issues, right? Because how long can they continue to pay the
Right.
dividend? So this is next era with, this is actually still a 5-year, but you'll see again the same thing. And if I didn't just explain that it's a dividend growth stock, it still looks like a hot stock, right? I mean, it's doing wonderfully as far as the price movement goes. You see the earnings growing, and then what's different here is now we have the dividend payout. This is just the dividend paid. Glenn, in this case, I'd like you to go to a 10-year graph, if you would. And it's what we used to call, it was called for something different, but I like to revamp the name, the Golden Staircase. Remember a long time ago?
Yeah.
But it wasn't for dividends,
I
but
do.
I'm reintroducing it. That's why I made Glenn put it in gold or yellowish down.
That's why you made me do
Yeah,
it. Okay,
exactly.
I got you.
So next year is what they call a dividend aristocrat.
Yeah.
A company that's not only paid but has grown their dividends year over year for at least the last 25 years. Many of them a lot more.
Would that be a drip stock too?
Yes, well, it would be a DRIP 25 plus.
Gotcha. Okay.
Right, so it has a dividend reinvestment plan, which is what the DRIP is, and we have several watch lists in our viewers tab. DRIP 5 to 9, DRIP 10 to 24.
This is a 25
This
plus.
is a 25 plus, so this would be the aristocrat. So again, what that subgraph is showing is not only a paid dividend, but a growing dividend over a 10-year, and if we went back even further, you'd see it more than 25 years. So I picked these stocks because the price patterns fit even a shorter term. You can make it a 3-month graph, and we can look at it that way. But I shifted gears, well, maybe not on the 3-month, but still doing well. I shifted gears because this is the outlook we have, and we may have folks who are watching who may be more interested in this type of stock. So that was my rationale for my 2 slow burn stocks.
Slow burns.
Slow burners.
Are you not worried about the drop in earnings back in May?
Not even a little bit. Relative safety is still very strong. There will be glitches throughout. Not every stock is going to have that perfect straight line there. We've seen it happen before, and partially because it is a utility stock. Growing earnings is important, but not as important on, say, a growth type stock.
If this is a growth type and I'm trying to stay in it and I'm growing earnings, I'm getting a bigger payday every year.
Yeah, it's like
Or
getting a raise.
actually every quarter.
Yeah.
I'm getting a bigger payday every
And
quarter.
you are combining capital appreciation over time along with that dividend payout. It's an amazing, and that doesn't, we haven't even talked about reinvesting. Well, we did talk about DRIP, but reinvesting the dividends and getting that. But that was my idea behind these stocks because, again, I just wanted to give a little different outlook on it, maybe a little longer term look, more prudent side of things.
I'm taking notes on a couple of your picks.
So you know what?
Because I already own your picks. So
So
buy
you
his
see,
first. I get the inside info on it.
this is the beautiful thing around this panel. I got Todd, who's a little bit more intricate in how he looks at things, and he just is. Sometimes I don't always agree with what he does, but he's really pinpoint intricate, whereas Patrick is a little bit more aggressive. Steve is somewhere between that aggressive, prudently aggressive type scenario. He's progressive. And I actually think myself as progressive as well, but he's a little bit more progressiver than me. And then I look at Jim. Jim is on the whole other side of the spectrum, but can still come up with stocks. that are hot stocks. And he mentioned, even if you weren't looking at this as a retirement, these stocks are moving up. These are still hot stocks. If I take the earning per share off, I take the dividends off, I take all the background, all of the retirement background off of that, that's still a hot stock.
Yeah,
Okay.
the way I'd say that is
What's that?
we run into so many people who are chasing yield,
Yeah.
but they're buying stocks that are moving against them faster than they're yielding.
Yep.
Right?
Yeah. Or
There are stocks out there that are doing what you want them to do and still yield.
That's
How
right.
about
Yeah,
that?
one of the golden
Well
rules
said.
is not to just simply go out and buy the highest yielding stock. I mean, we could sort the database and find dividend yields that are through the roof.
it's usually
Right,
a problem.
But yeah, there's you're setting yourself up for bad news. So
And that's something we just learned from the retirement guy. That ain't Steve. And you put together. But there you
I
go.
think we all know that one.
We all know. And knowing is half the battle. All right. Go, Joe.
At least
All
I
right.
hope we all know that one.
Are we good? Yes? Anybody else have anything else they want to add to it? Good picks, actually, Jim. I really wanted to go after you because they were, but I can't. Those are good picks.
and hey, those are just two examples. VectorVest will find you a portfolio full of both of those type of stocks
Yeah.
when you
Excellent.
use the right parameter.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.